Okay, I think we should get started. Good morning in India and good afternoon in Australia. It's a pleasure to have you all joining us today for the NGG Australia-India webinar on India's financial services and infrastructure sectors. We have two very distinguished speakers with us today joining us. Mr. Balasubramanian is the Managing Director and Chief Executive Officer of Aditya Birla Sun Life AMC Limited. And Mr. Prakash Rao is Executive Director Investments for the National Investment and Infrastructure Fund. They will both be talking to us on their relevant sectors. We will start off this afternoon with Bala. I hope you don't mind me calling you Bala.
Yeah.
The government of India and the Reserve Bank of India has introduced various economic and fiscal stimulus measures to tide over the COVID-19 crisis. To navigate through these unprecedented times, the financial sector needs a strong focus on liquidity, credit risk, well-being of its employees, along with the quality of financial reporting and disclosures. So Bala will talk to us about that. I'd like to introduce you to Bala. As you've heard, Bala is the MD and CEO of Aditya Birla Sun Life AMC Limited. He's been with the company since 1994, and he brings with him over 26 years of experience in the mutual fund industry as portfolio manager, both in fixed income and equity. Prior to assuming the role of the CEO in 2009, Bala served as Chief Investment Officer. Birla currently oversees nearly 36 billion assets under management, which is one of the leading asset managers in India. He also oversees global mandates through a subsidiary company in Singapore and Dubai, having assets of close to $1.8 billion. Apart from overseeing alternative investment funds, real estate and portfolio management services, Birla is closely associated with key industry bodies. Currently, he is on the board of governors of the National Institute of Securities Markets, which is a securities and exchange board of India, established entity. He is also on the Committee of Corporate Bond Market Development of SEBI. Apart from these prestigious roles, he plays an active role in Association of Mutual Funds in India as a board of director. He has also held positions of chairman of AMFI for 2 years, from 2016 to 2018. Bala, over to you. Thank you very much.
Yeah, thank you for this kind introduction, and also my pleasure to be part of the webcast series of yours, and thank you for inviting me for that. I'll just share my screen. Are you able to see my presentation?
Not yet, no.
Okay. Okay, I think it got stuck. Sorry. Just. Yeah. Are you able to see it?
Yes, we are.
Yeah.
Yes.
Okay, thank you. Thank you for inviting me to be part of this session. As Dipen mentioned, that I've been part of the mutual fund industry, managing money, tracking market, and working with various bodies in terms of framing various policies and so on and so forth. So I thought I'll talk about the what is happening in the financial market, and before that, I want to just state a few of the facts that how the Indian markets have been behaving. This is the way I think the Indian market in general has behaved. Just to give you some kind of insight. Thanks to, of course, one COVID, and before that itself, the world economy was actually slowing down. And then except the healthcare index and FMCG index and consumer durable index, and also to some extent IT, and most of the indexes have done badly given the slowdown that we witnessed in India just before the COVID itself. And why I'm specifically saying this is the almost about 1.5 years back, Indian financial systems went through some tough time. One of the large institution filed, which is an ILFS, infrastructure funding company, and post that the entire financial market came very cautious about credit market, and post that the government of India took various measures, but despite that we saw some kind of risk aversions leading to that, and therefore we saw generally the growth was slowing down. Because COVID actually is the yes.
Bala, may I request you to expand to full screen?
Yeah. Is it coming all right?
No, it's actually shrunk. If you go to your PowerPoint and just put it onto
Yeah.
On the top left.
top left.
Yeah, that's what I'm saying.
Top left. There's a slideshow mode. Yeah.
No, the yeah, only this much is coming.
That's okay. That's all right.
Yeah.
No problem.
Yeah. So as a result of that, I think COVID had a further impact in terms of the growth slowing down. I think you'll see the chart, the declining trend in terms of the number of active cases. Of course, is slowing down in India, but naturally, of course, it had an impact on the overall GDP growth. With respect to the COVID, definitely we have seen an improvement in the last few weeks in terms of, I think if you look at the trend, I think it's been slowing down in terms of the trending downward trend. That's something which I think giving some kind of comfort as of now. I think a number of states, unlike what is the perceived notions, the number of states got impacted. Were only about Maharashtra, Gujarat, and Delhi. Few of the states got impacted, but again, it got restricted to a few states, and most of the states, I must also mention, that have managed to actually maintain the overall the impact of COVID very limited. And this, of course, made Reserve Bank of India, I think 2-3 things which have happened. One, of course, the previous pre-COVID, where the economic slowdown was coming, and post-COVID, the slowdown that we have seen in terms of GDP growth, as we have seen in the global market. I think, as we all know, then the Fed became very extremely aggressive in terms of quantitative easing, pumping in trillions of dollars into the support the financial market. And India also did quite aggressively in terms of rate cut. I think we Reserve Bank of India on 27th of March cut the rates by almost about 75 basis points, and they also, of course, introduced new instruments which called long-term repo window. They also came with a new instruments called targeted repo window to provide liquidity to the struggling financial services sectors, mainly to the banks. And this, of course, led to a significant increase in the liquidity. I think this chart that you will see that the banks have actually gone and parked close to about 7 trillion Indian rupee with the Reserve Bank of India at repo rate. That again is its reflection of the liquidity. And having said that, I think the overall, I think what we have seen in the last few years, I think we see the declining trend in the loan growth. I think post 2018, the Indian economy in general, there has been a credit contraction. There has been a deposit growth which is increasing. At the same time, there has been risk aversion. And post-COVID, I think it further aggravated of risk aversions increasing. As a result of that, we have seen actually general credit growth declining in India. The advances versus deposit, if you see the charts, the advances have been coming down, and then deposit growth has been increasing. And at the same time, the entire banking systems have also been not focusing much on the lending, and they are more in the preservation mode. And that's something which I reflected in the previous slides of the banks are going and putting all the surplus money with the Reserve Bank of India and at about 3.75%. Having said that, I think and the right side of the chart, if you see the loan growth to the industries has been declining. I think there has been I think as we showed in the first slides, the way I think various sectors have performed. Sectors like metals, sectors like autos, sectors like cyclical sectors, sectors like NBFCs, I've been seeing actually declining acceptance from the banking systems from extending advance point of view. At the same time, the loan growth, especially the retail, has been steady, except that I think post-COVID, the lockdown clearly I think is going to have an impact on the way I think the consumer loans market will also be getting impacted. And the Reserve Bank of India did one more thing I think during this period. Normally in the last 4 or 5 years, they have been becoming extremely cautious and conservative in terms of giving some kind of leeway to the banks for making the provisions and recognizing NPAs. And during this period of COVID, they have relaxed such recognitions. I think they have gone ahead and introduced a moratorium for those companies who are not able to meet because of the lockdown. The sales are getting affected and the payments are not coming. Therefore, they need to be given support. The Reserve Bank of India has given a moratorium up to 31st of May for all such payments that's coming for due. They can actually extend these maturities as they wish, depending on the mutual consensus basis. At the same time, even as a consumer, if I'm a consumer and not able to meet my payment because I'm locked down, my income levels, our income of course is there, but I need to preserve the cash, and therefore I'm not able to meet the payment. Then naturally, the government of Reserve Bank of India has given this extension of moratorium for such kind of borrowers. I think one of the things, of course, is during this period, I think government made an exception towards agriculture sectors. What remains as a hope at this point of time is the rural economy continues to deliver better performance. I think the agricultural crop the last year was much better given the good monsoon, and this year too the monsoon is likely to be setting in sometime in the month of May. There is an expectation that so far the IMD, which is the forecast agency for rainfall, has predicted a normal monsoon for the year 2021, and that's actually has somewhat a positive impact on the rural economy. This again something that's coming as a silver lining. And in fact, the government of India during this period has given somewhat of impetus to ensure that rural India remains strong, though the lockdown was applicable across the country. Every part of the country was under lockdown. Having said that, some of the rural economy where the populations are low, given the fact that the impact ratios are also less, and most of them actually do not come in the red zone, I think they have allowed the labor workers actually continue with agricultural activities. Therefore, you don't see much impact coming from agricultural activities as we move forward. And this is basically more on the way I think as I mentioned about earlier, there has been a dip in the whether it is the loan towards the large ticket loans have been coming down, and loans to the automobile sectors have also been coming down. And because of this reason, this again nothing to do with COVID. It is something to do with the government of India was trying to actually move towards electric vehicle introduction, and that gave some kind of impact on the automobile sales. And second, the BS6, which is supposed to be introduced the 1st of April, had an impact on the sales of automobiles companies. And these two put together, we have already seen an impact on the entire automobile sectors even before the COVID. The government of India has been working with the industry bodies for quite some time in introducing a scheme called scrapping systems. India does not have scrapping systems, unlike most of the countries in Europe. And government of India has been seriously engaging with industry players, both the auto manufacturing companies and global consultant, to introduce a scrapping policy across the commercial vehicle market, as well as the entire auto sectors, which in my view could potentially impact positively on the auto sectors. And this is the way I think the overall the consumption in terms of an impact. Definitely, I think in the sectors, various sectors is operating in India. Consumption sectors continues to remain reasonably good. Is the discretionary items were low ticket items. There we continue to see a growth. At the same time, having said that, we have seen, of course, a dip in certain segment of the market in the consumer segment, mainly because of the lockdown. At the same time, in the banking finance service sectors, if you divide them into various categories, where the consumer segment loan where they are focusing, as well as the corporate banks and insurance, and that sector, I think we have seen somewhat of growth, especially on retail. We are seeing actually reasonably positive outlook coming in as we move forward. Corporate, of course, loans will take some kind of time because of risk aversion. Having said that, in sectors like insurance sectors and banking, mutual fund sectors continues to dominate in the financial sectors. The other sector which is quite dominant for India, I think pharmaceutical sectors, which have seen a significant underperformance for the last 3-4 years. I think clearly we are seeing some improvement on the pharma sectors post this COVID. I think Indian pharma companies are now becoming higher, maybe the part of the recognition from global industries. That's why we are seeing pharma industry also is coming back. And I think what we see, I think moving forward, I'll move on to the what actually in terms of valuations. I think clearly the GDP growth coming down, definitely I think is taken up with the earnings. I think we have seen in the chart that 12.5% of earnings that we saw in the 1919. Naturally, the earnings growth for companies getting impacted. 2020, I think, is going to be literally a washout year from the earnings point of view. We will probably see the earnings coming back in 2021. At the same time, there are certain sectors where the high impact, which I think we see that consumer staples, farmers, and utilities probably will have a low impact post COVID. At the end of the day, consumption will come back. And banking and finance service sectors, I think impact is quite high. Given the fact that, as I mentioned earlier, the loan growth is coming down, deposit is rising, there has been a contraction in terms of rates. Just to give you a sense of how the rates have behaved, post Reserve Bank of India cutting interest rates to about 4.4%. The government bonds have been trading about 6.3. Naturally, the repo rate, which of course is the benchmark rate that we take, and the 10-year government bond yields, there should be just about 1% gap. And this not happened. The gap is still about close to about 2%. Given the fact that the fiscal room for the government of India is very limited, given the fact that we are already running at about 3.5% fiscal deficit, and any fiscal stimulus we have to give, which could be in the range of about 3 trillion in rupee, or maybe about 5 trillion Indian rupee if we give it, and it can potentially have a high fiscal impact. Therefore, they are of course trading it very cautiously as to what are the ways and means in which they can give the support. Therefore, that's of course holding the rates high. At the same time, that the risk aversion, which I just mentioned about earlier, we have seen actually a shift in terms of yield curve. I think the naturally in this kind of market, unlike in the US, where the US Fed actually is willing to buy bonds which are below BBB up to BB plus, they're willing to buy the bonds directly from the issuers of the bonds and directly pumping liquidity to the companies which are suffering. Whereas India, of course, routing all such support through the banking system. It is State Bank of India, public sector bank, private sector banks have been provided the support. Of course, given the fact they also have their own balance sheet, given the fact they also have their own shareholders, and given the fact they also have the responsibility to the government, various bodies, they've also been quite cautious in terms of lending to the lower credit papers. As a result of that, while the rates have come down, we have seen actually the spreads widening. I think spreads are widened, corporate bond credits below AA and AA plus, the spreads are not really contracted. This is what I think Reserve Bank of India is actually trying to do in bringing down the transmission rates to its core. So far, what they have tried has not really worked. I would assume as we move forward, the next few weeks, we'll get to hear the next few days from RBI that they'll probably put a cap. That today, most of the banks, on the basis of risk aversion, going and keeping the money in RBI, there is a high probability Reserve Bank of India will say that I'll not be able to take more than a certain amount from all of you, which is linked to your balance sheet size. The rest of the money that is coming back to you, that's lying with you, have to be lent in the market at whatever rate that we want to give. That's something which I think Reserve Bank of India is planning to give. And second, of course, an equal support which is likely to come from the government. Like US, the loss given ratio in India, I think is estimated somewhere around 5 to 10%. And the government of India, I think, finally seems to be keeping aside some kitty of funds through an SPV format to provide the guarantee to the banking system as a whole to revive the overall sentiment on the lending side. I think in order to remove the risk aversion, I think they are also planning to actually underwrite up to 10% of the loan given by the banking system to MSMEs, SMEs, and large corporates. They are actually willing to provide some kind of guarantee. Hopefully, in the next few weeks, may not be in the next few weeks, probably the next week, we may see some kind of announcement coming on these lines. Once this thing comes, naturally, I think the Indian bond market probably will see some kind of shrinkage in spreads. And what we have seen, the elevated spread that we have seen, we'll see the spread contracting. And that's something I think will boost the, in some sense, the rate reduction for corporates leading to an earnings improvement and also the investment cycles coming back, which I see about 6 to 9 months away. Having said that, Indian equity market has given reasonably good bounce back on the hope that I just mentioned that one, rates having an impact on earnings. Second, government of India pushing the entire reforms towards reviving the economic growth. And these are some of the things that actually impacted the equity market sentiment. Having said that, the equity market has dropped actually the earnings yields of the companies and the bond yields. I think have reached actually substantially higher number. Earnings yield today is relatively equal to the bond yields. That's something I think has put equity as an attractive zone. And second is the price to book multiples is actually at the last 10 years lowest. I think if you take the average, it's close to about 2.8 times, and the price to book multiples for Indian companies have gone below the 2.8 times, which of course the long-term average below the long-term average. This again something is made equity become a little attractive. At the same time, the PE multiples it's again gone below the long-term average of about 19.2 times, and today has gone below close to about 17 times as just about 3 weeks back. Now it's trading close to about 18 times. On the basis of even trailing PE as well as the forward PE, I think the PE multiples have become very attractive. And then the last, of course, is the market cap to GDP has fallen quite substantially. There was a time where when the economic growth was coming close to about 6 to 6.5%, the general expectation was that we'll probably be able to maintain 95 to 100% of the market cap to GDP. Post this recent fall on the back of COVID-19 impact, the market cap to GDP has fallen quite substantially to 68%, which also made all of us to turn extremely bullish. And finally, in terms of flows in the Indian equity market, I think FI's flows were extremely negative for about 4 or 5 months period. I think only the saving raise during this period was coming from the domestic, the savings which has been coming to the mutual funds, which has been coming to the insurance companies, has been rising every month. And the Indian mutual fund industries have actually, like Australian market, like US, like 401k, I think Indian mutual fund industries have actually made SIP way of investing, which is monthly small amount getting invested every month. That way of investing has now become a habit for Indian mutual fund investors, and that has become actually a savior for the Indian capital market. I think one of the questions which normally come from most investors, how long these flows in Indian mutual fund industries will sustain, and that's something a question comes, and how long this will going to continue. The way I see is the financial market is getting it got impacted, but at the same time, mutual fund industries and insurance companies being the industry which actually collect the savings of public at large, has been seeing the inflows again on the back of low interest rates. People don't have much alternatives to invest, and that's something helping the financial market stability as well. Just summarize the last few months of the slowdown impact. Clearly, I think it made the financial market to completely shaken up. The financial systems has gone completely risk averse. In order to change this sentiment, clearly the Reserve Bank of India has been taking many steps, as I mentioned earlier, and they have promised that probably they'll continue to take more steps, unlike in US where they just come and take one big bang approach. Of course, in India, we have been taking small approach. There is high probability in the next few weeks, we will see more measures coming from Reserve Bank of India in pushing up the confidence of the investors. And the way I think we see as a fund house, we'll probably see the way the liquidity is there in the banking systems, which are not chasing the yields at this point of time. There is a time, actually, the next few months, I think people start chasing the yields, given the fact that the credit growth is coming down, deposit growth has been rising. Probably the time will come where the banks will be pushed to the corner, that they will not have enough room to maintain NIM at which the net interest margin, at which they have been operating for the last 4 years. That I think going to be shrinking. And second, the alternate way of income that used to come from the financial services business, such as PE of funds offering like PE, or maybe selling the mutual fund products, or maybe selling the insurance product, and all they used to give big commissions. They're also going to shrink, and therefore the banking industry will come under pressure to go and increase the lending activities, which is what I think the Reserve Bank of India is hoping. Which, in my view, that starts coming in, combined with good monsoon, and combined with the government of India steps that they are planning to take in boosting the economy. I think all put together, I would assume we will see the sentiment coming back towards better economic growth from June, July onwards. I'll stop here, Dipen, and maybe I'll answer some of the things that through the Q&A sessions.
Sure. Wonderful. Thank you so much, Bala. That was very informative. I've already had questions for you, so we'll ask them at the end of the session, and some have asked for your presentation too, so we'll provide that to them. Bala, again, thank you. I'd like to move on to our next speaker. The infrastructure sector has a major role in the overall growth and development of any economy. Last year, the Indian government had released the National Infrastructure Pipeline for enhancing infrastructure in identified sectors for a period of 5 years from 2020 to 2025. India's need to spend about $1.4 trillion over these years on infrastructure. The plan will help India to reach a $5 trillion economy, which I think that was done prior to COVID-19. So I think we might have been put back a little bit on that. And how the COVID crisis has affected the infrastructure sector. Our second speaker is Prakash Rao, who is the Executive Director Investments for National Investment Infrastructure Fund. He has over 3 decades of experience in the Indian financial system in areas including corporate finance, project finance, infrastructure lending, infrastructure investments, and credit risk management. In his most recent role, before joining NIIF, Prakash was the Chief General Manager of the State Bank of India. He was also the Deputy CEO of SBI Macquarie Infrastructure Fund, where he was instrumental in the fund's investments into airports, telecom towers, thermal power, small hydro, and transportation sectors. Over to you, Prakash.
Thank you very much, Dipen. And first of all, it's been a great pleasure for me to be part of this particular webinar. So thank you very much for that. And secondly, I also want to thank Bala for his informative setting of the context and how the COVID impact has been taking place, and what the measures that both Reserve Bank of India and Government of India have come up with. Before I start, I think I should talk about the NIIF. NIIF had been set up. Actually, it was announced in 2015 by the Government of India in its budget, and it took a little while for them to figure out how exactly they need to do. So first of all, they decided to go for identification of a CEO, and they did an international search. They felt, when they had announced it, they felt that there is a large equity financing gap in the Indian infrastructure space. So the other thing, that the main consideration was, the banking sector in India has actually been meeting most of the debt financing needs for the infrastructure, but equity was in short supply. So the government thought that it might be a good idea for setting up an infrastructure fund where they actually contribute some amount of capital and catalyze international capital into this. So to give credit to them, they have restricted themselves to 49% of whatever we do. And secondly, they had left this strategy to the team who they were supposed to be identifying. So, when the CEO joined, then we have a clean slate actually to create the strategy. And we felt that this is a unique PPP model where the government contributes a catalytic capital, but they take a back seat in terms of strategy, in terms of decision making, in terms of hiring, in terms of governance and everything. So how did we go about building this institution? The first and foremost thing that we look for is, how do we create a multiplier impact of the government capital into the Indian infrastructure space? So what we have done is, we have created 3 funds. These 3 funds are, one is a core infrastructure fund. This invests in operational assets through sector-specific platforms. These sector-specific platforms are created in joint venture with internationally renowned operators. So that's the first fund that we have set up. These platforms also operate at a scale, and a scale which has not been seen in the Indian context. The second fund is a fund of funds. We felt that the Indian fund management ecosystem doesn't have any fund of funds, any pool of domestic capital that they can go to. And mostly they were actually, the first fundraise itself has been a major challenge for the Indian fund managers, private equity fund managers. So we felt that we can anchor them, and we can create, also we can create new fund managers in sectors that actually help the economy and where there are not really too many fund managers. So that's the second strategy that we have adopted. And the third strategy is essentially a large-scale private equity type of fund, which is actually taking care of strategic opportunities in sectors that are strategic and of importance to the country. So these are the 3 funds, and the way we have structured it is, because of the platform investment and also the investment at the SPV level, it actually multiplies the government capital. Similarly, our investment into the fund of funds, because we are raising capital at the fund of funds level, we are also investing in funds who are again raising capital at their fund level, and finally the projects, they are taking debt capital. So it has actually a much larger multiplier impact. So the first and foremost strategy that we have adopted for setting up NIIF was to create a multiplier impact of the government capital. The second most important thing that we had thought of is the governance structure. How do you go about when you have 49% of your investment is coming from the Government of India, and when they own 49% of the asset management company? So what we had done was, we had said that we will have a board structure where actually all the investment managers, investors would have actually a board seat, provided they come with a certain amount of contribution. So this is like, the IFM 20 years back, what they did in Australia, all the pension funds, they have come together and created a fund manager who was managing their fund investments, and subsequently the fund managers themselves have, the pension funds themselves have got the expertise. So we have chosen a somewhat similar path where we said the investors own a part of the fund manager and they also get board seats. So this is again a unique construct. And we have, of course, we have got independent board directors. We have one independent who was an the finance director of Tata Sons, and another independent director who was an ex-IFC veteran, and she has her own her own fund. And we have brought them on board, and we have brought the government of India actually to a minority on the board. On the investment committee, not a single investor gets a seat, and it is left to the professionals who are manning the fund management team. So that's again something that we have done. The governance structure has been robust and has been of international standards. That's the second most important thing that we have done. The third thing is hiring of the right kind of professionals. We have actually, with the government, we have agreed upfront that all hiring will be from the market, and it would be completely at an arm's length from any of the public sector or the government structure. And today, I'm glad to say that we have roughly about 65 professionals, 3 years since we have set up, and all of them have been hired from the market, and all of them come from infrastructure investment experience in the Indian space. So that's the other important thing that we have done. And the fourth thing is, of course, the investment strategy itself, which is operating at scale over longer tenors and acting as a beachhead for international capital. Essentially, local access and expertise for the international investing community is what our goal was. And finally, when we have created a credible organization, that is where the international and foreign investors have actually understood that this is a different institution that has been set up, and they felt comfortable. If I have to actually define NIIF, we want to be a partner of choice for international investors, international operators, domestic fund managers, and of course, government itself. We also felt that, we need a debt platform because equity is all right, and when infrastructure is being talked about, we need 3/4 of it comes from debt. So we have created a debt platform as well, which I'll speak a little later. Now, if coming to the infrastructure opportunities in India, obviously, before I speak, I have to speak about the COVID impact and how the infrastructure sector is panning out. The COVID impact is, I think, has caused an enormous impact globally, and I don't think India is an exception. Many countries are seeing contraction in GDP, and I'm hoping that India actually grows. It will have a positive growth of GDP even during the FY20. More importantly, it has created uncertainty. As infrastructure investors, we would like to see predictability and an amount of certainty. So infrastructure investment at this stage obviously creates the decision making is quite challenging. Having said that, I think in the long run, growth would return, and slightly differently from what we have seen so far. But the short term is going to be extremely painful. We'll see a massive liquidity crunch over the next few months, and we also feel that several sectors will be severely hit, particularly sectors like aviation, tourism, hospitality, shopping malls, automotive. These are the sectors. Even convention centers, sports facilities. All of these will have a massive hit, and they might find it a little difficult to come back very quickly back to the original growth rates. There are some other sectors like the logistics, etc., which could actually come back much quicker. And of course, there are sectors like telecom and healthcare, which are not so much impacted. In the short run, the other major worry is the supply chains are disrupted because global lockdowns are there, and how quickly the supply chains are restored is again something that we need to do. So what we need is actually, I think we require a calibrated approach to come back to growth. And that's what I think the government is looking at, and the Reserve Bank of India is also looking at. Instead of, Bala is also referred, instead of big bang, announcement, what the government is doing is to have a calibrated approach. And as you have mentioned rightly, the infrastructure investment plays a major role in the growth of the country, in providing employment, and it will be, and also meeting the aspirations of the people. We should not forget that India is a 1.3 billion population, and we have almost like 70% of the population is less than 25 years of age. The demographics actually are in India's favor. So once the COVID impact wears off, maybe in 3 months' time, maybe in 6 months' time, I have no doubt in my mind that growth would return. For this, what can be done is what all are we looking for, right? So in my view, the government of India should definitely focus on completing the infrastructure projects that are currently underway. Secondly, obviously, the new infrastructure needs to be built. And for this, we need to see how actually domestic capital can be harnessed. There is a question as to how the government, whether they will go about the PPP projects in the same way they were going about. Does anyone have appetite in the country is what one of the questions I have seen. See, I think eventually the government will not, all over the world, governments will not have the capital to build the entire infrastructure requirements, and it has to be in some form of PPP. And the second thing is the government also have to, once they build the infrastructure, they have to monetize the assets and recycle and bring in international insurance companies, domestic insurance companies, domestic pension funds, and international pension funds, because in my view, infrastructure assets, because of their regularity of cash flows, they actually are very well suited for these type of investors. Now, you have alluded to the national infrastructure pipeline that has been recently adopted. A couple of days ago, the entire report has been submitted to the finance minister, and finance minister has unveiled, and the government has identified projects worth $1.4 trillion of investment in the next 5 years. And obviously, this is a major opportunity for investors, operators alike. It is how this is to be addressed is a larger question, and I think the government is trying to bring in the domestic pension funds, the domestic savings, and also try and catalyze investment by coming up with innovative models. So if you look at even before the COVID impact itself, the hybrid annuity model for toll road construction is one of the innovative things that they have come up with. The infrastructure investment trust, which are modeled on REITs, that's again an innovative model to attract long-term capital into the infrastructure space. The banking sector has actually been a little, they had a little bit of setback in the twin balance sheet problem that they had faced, but the impact of the insolvency and bankruptcy code has actually resolved quite a few assets, and they have actually gotten back a major part of their money back. So, and I also think that there is a scope for new institutions which are well capitalized, which can lend long term, which have access to long term bond markets. That is the type of institutions that are required. And as I said earlier, I'll speak a little about our debt platform and how we propose to go about this in lending to the infrastructure space. Coming back to the infrastructure opportunities, India definitely requires a huge amount of toll road constructions, expressways. We have not got so much of expressways as yet. So the pipeline comprises so many expressways. We have the dedicated freight corridors that are coming up. Then we have we have a huge amount of renewable energy, renewable energy growth opportunities that are coming in. I think that the opportunities for infrastructure investments would continue to be there in a country which is starved of infrastructure, which is starved of facilities. And on top of it, there are new kinds of infrastructure like, healthcare infrastructure, the digital infrastructure. All of this will also be offering a lot of opportunity for investments. I think healthcare infrastructure is something that would see a huge opportunity, because not only in terms of creating more hospital beds, in terms of creating actually click and mortar sort of healthcare facilities, all that will come. Then secondly, on the digital infrastructure space, the data centers, of course, is there, but on the fiber, because we have all moved to all these Zoom video conferences and all that, and this requires a huge amount of fiber space. And I think that is, again, that's an opportunity that is waiting to be tapped. And as for NIIF, I think we are uniquely positioned at this moment because we have raised capital. We are currently managing roughly about $4.5 billion in funds and another $3 billion of co-investments. So we have about $7.5 billion, and most of it actually is in the form of dry powder. And I think we are uniquely positioned at this moment to actually take advantage of all the opportunities. Also, because of the stress and the liquidity crunch that COVID has created, we have been seeing a huge amount of opportunity in toll roads, in renewable energy. So the people who were banking on debt for most of their requirements, they are now not in a position to meet them anymore, and they are actually getting out of these assets, and that creates a huge amount of opportunity for us. I think the next few months we will see a lot of investment opportunities, and we are geared up for it. We have a lot of local expertise in our team. We have seen most of the assets, and we are uniquely positioned to capitalize on that. Against this backdrop, I'll just get into how we have gotten into AustralianSuper and how AustralianSuper found comfort with NIIF and what exactly they had seen in us and how we went about it. So the NIIF's journey with AustralianSuper began actually when our team visited Australia. At that time, we met quite a few super funds, and we found that many of them have not realized the rapid strides that India has made in the last 10 years. And they were actually smarting under their experiences, which were not very good 10 to 12 years back. So what we have done was we have actually taken them through all the things that have happened, what the government has done to improve the investment landscape, and what are all the opportunities that India is presenting. Then that was followed by actually, we have requested the AustralianSuper team to make a visit to India and said that why don't you see for yourselves what we have been able to do. And so that was, and then we have planned their trip as to who they will meet and how the overall landscape they will understand. So we have actually, the CIO of AustralianSuper brought, I think, a 14-member leadership team to India. And we have facilitated interaction with the private sector, public sector, banks, Reserve Bank of India, and government officials, which had given them a complete perspective of two things. One is, of course, the Indian infrastructure landscape where they are very much interested. And second, how NIIF has been able to position themselves in close quarters with the government. So we have the ability to actually give policy advice to the government. We have the ability to get industry feedback to the government, so that we are not looking for just the NIIF making more returns. What we are looking for is to actually improve the climate for all fund managers, all investors, so the government is comfortable that NIIF is not somebody who will just try to make a higher IRR on their projects, but actually they are bringing in something which will be greatly useful for the country itself. So that has led, I must say that AustralianSuper, their investment team, they are very, very careful because they know that their constituency is pensioners, and they have to protect their corpus, and they have to make the returns so that they are in a position to pay pensions on a regular basis. They have been extremely conscious of that, but I think in the end, they have actually seen that what we are saying is not just saying, and they could see for themselves, which had led AustralianSuper to make investments with us. We are proud to say that we have got very quality investors like not only AustralianSuper, Ontario Teachers, CPPIB, and of course Aditya, who was the early backers, who had actually seen the potential that was in the making in NIIF. Finally, I'll just touch upon the financial sector. Bala had covered a lot. See, basically in the financial sector in India, you have banks, you have shadow banks, and microfinance institutions. I will not touch upon the insurance and mutual fund sector, which is Bala's forte. But the thing is, COVID has impacted all three segments of the debt space: banks, non-shadow banks, and microfinance. Now, this is a time, actually, there may be a lot of recapitalization requirement for banks, and India's growth story will come back in the next 12 to maximum 12 to 15 months. And all this will actually, investors who get into the banking space, into the financial sector space, they are going to make substantial returns. What we have done is, as NIIF, as I mentioned earlier, we have created a debt platform. We felt that banks are getting out of the infrastructure space because of the asset liability mismatches that they have. And the earlier infrastructure lenders have all converted themselves into banks. There is an opportunity for us to set up a debt platform which comprises of well-capitalized, well-governed, well-structured institutions which have expertise in long-term project finance. And I'm glad to say that we have two shadow banks that we have set up. One is one lends to operational infrastructure projects, and the other can lend to greenfield and brownfield. And we are building up both of these to the scale that NIIF is actually always wishing to operate in. So that is the shadow banking space that we have set up. And I'm also glad to say, 1 year back, we have set up the first institution. We have acquired a first institution, and since then, we have created a lot of value they are able to actually make use of the expertise that NIIF equity teams have. And this, there is a overall ecosystem for infrastructure financing that we have created. So this, I think the overall, my view is the infrastructure space offers great potential for investment because of the aspirations, because of the demographics, because of government policies, because of the need, the necessity for infrastructure in India. And secondly, the financial sector space might actually go through a little bit of a pain in the short run, but when they come back, actually there is the sky is the limit for them to grow. So these are a few thoughts that I thought I should cover. I'm glad to take any questions that come up.
Wonderful. Prakash, thank you very much for that thorough understanding of the infrastructure space in India, where it stands currently and what we're looking for as the opportunities in the future, and also covering the Australia portion. Appreciate that. And I think there's a lot of Australian companies here that are on this webinar that are very interested in that. We actually have almost covered an hour, but I'd really like you both to stay on because we've had some questions. Are you okay with that?
Yeah.
Yeah, no problem.
Excellent. So let me start off with the questions. First one is from Mr. Baljit Kohli, and this is for Birla. Sir, what did the credit rating of India's governance miss with regards to Franklin Templeton? How come we in India, investors are protected with transparent reporting? And that also covers not just Franklin Templeton, but Yes Bank, ICICI Bank, ILFS, and DHFL. Birla, over to you.
Yeah. Just to give you some insight on the Franklin Templeton, I think the last few years before ALFS crisis, not few years, but the last 5 years, the money managers have been trying to develop the bond market, especially mutual funds have been taking the lead by going down the credit curve. I think they go and invest in A+ and above papers, and they have been predominantly when the banks started withdrawing the funding of promoters and some of these cyclical companies, and with the right governance, with the right structures, they have been the funding. And Templeton have one fund house have been specializing on credit related investment that they make below the investment grade, not below the investment grade, of course below the AA+ and above investment grade. And as a result of that, he has accumulated huge assets, and then portfolios became illiquid, especially as I mentioned in my own presentation, when people start withdrawing from the credit market, especially the bankers, so they start funding. And after the ILF crisis, everybody started funding the NBFCs, and the mutual funds were actually the funding because the money is available for 3 years and 5 years. So that's why I think it came, and that SEBI as a regulator from the governance point of view, while of course they said that mutual funds are pass-through, you can run the schemes as it is basis, but since it's a pass-through, and the investors have to take the risk, and therefore you need to bring in certain practices like valuations, if the rating downgrade happens, how you impact on the portfolio, etc. So that's the way it came. And Franklin Templeton, because he had a continuous redemptions, he had a choice. He does a fire sale in the market of all the security that he has, in which he may or may not be successful, which will further erode value for the investors in the portfolio. And therefore, despite his spoiling his reputation, he took the call of shutting down the funds of 6 funds, where he had a huge exposure to AA- and below, just above investment grade. I also had seen some delay in payment post-COVID moratorium that is being asked by most of the companies. As I speak, yesterday is one of the company who operate in the retail space, as Mr. Rao mentioned about he runs in the malls and big bazaars, and the promoter had of course postponed the payment because cash flows are not there to make the payment. So you have to go for a moratorium. See, when he have shut down these kind of funds, he's able to use the moratorium, he's able to provide necessary impact on the portfolio, though it comes at the cost of his reputations. I think they all happened post ILFS. I've been telling at the public forum that had you saved ILFS and institutions way back in September 2018 by pumping in about 10,000 crores, government of India probably could have saved about $1 trillion. They would have saved for government itself, because a drop in GDP is actually came on account of shrinkage in the shadow banking and confidence in shadow banking. And whereas ICSA, I think I took the name, I think you took the name of ICSA. I don't think there is absolutely no issue with ICSA and ICSA Bank. And ILFS now they are of course finding a resolution, and hopefully another 6 months we'll see some resolution coming in.
Thank you, Bala. We have a question from Dr. Priyadarshi Dash. It's for Prakash. Mr. Rao, you allude to several innovative long-term financing instruments for infrastructure investments. How do you see the prospects of land value capture, impact bonds, municipal bonds as innovative supplementary sources of funding?
So thank you. This is a very interesting question. And see, on municipal bonds, already there have been municipalities which have actually been able to tap the bond market. See, basically, you know, there is a legacy on the municipalities and municipal corporations, and slowly they have realized that the best way is to actually clean up their books and have the revenues earmarked for meeting the bonds, the coupon on the bonds, and the redemptions on the bonds. So I think municipal bonds is actually slowly catching up. It's some of the, I think four municipalities have already come up with their bonds and they have been subscribed, 4 or 5. My view is going forward, it's a very, very good thought, and we would be in a position to help some of the municipalities actually tap the bond market. And also, you know, it's a competitive federalism, competitive environment in India. So if someone does it well, naturally, immediately people will start looking at, and I think it will spread. The second question is on the impact bonds. So impact bonds, I don't think we have actually tapped as yet. See, the impact bond market, world over has not actually, it's only addressed towards a certain type of investors, and impact bonds, disaster bonds, these are some of the things that are in the process of developing. I think impact bond definitely is something that we should try, and I think maybe we should also be helping some of these issuers to do that, so that actually that's another source of funding that these people will have. Actually, green bonds are already being issued, so only all the renewable energy generators, they have actually been issuing green bonds. So that is almost similar to what you have mentioned. So these are the two things that are already in place. Which one is the land capture? Capturing of land value. Actually, Amravati, the new capital of Andhra Pradesh, have tried to issue the bonds which actually capture the value of land. They have been successful. It has not taken off in a big way, but I think that's also again a great innovation that the earlier state government of Andhra Pradesh has done. And I think wherever the land value capture, if they're doing large scale townships or something like that, then this is definitely a mechanism that can be used. All three are innovative instruments, and slowly they are catching up. There have been sporadic instances of these instruments we haven't been used, but yeah, it's great if we can help some of these issuers.
Thank you, Prakash. And Bala, I have a couple of questions here. I'll read out to you from Ram from Tap Capital. How do you see asset allocations globally will change post-COVID? Which countries, in your view, will allocate bigger funds to India more aggressively post-COVID? Will the bigger geopolitical sentiment towards China be an advantage to India, or will the global asset management industry look for more opportunities in the local market, given the current economic and political uncertainty?
Yeah, I think interesting, Ram. I think one of the bet that I think India and Indian government and I think is trying to make. I think post COVID, especially China going through a tough time, the supply chain, entire supply chain industry is getting impacted because most of the global majors have got China as a base for outsourcing of their materials. Naturally, there's likely to be a shift towards India. I think Modi, before he went to US last year, he made an announcement of cutting the corporate tax rate to 15% for new industries who are setting up new industries in India before 31st of 30th June 2023. At that, I believe there is a high probability such investments will come into India. Second, from the global investors' point of view, I see US would continue to remain one of the big investors in India, given the fact that even so far the money that has been coming into India, either from pension funds or the actively managed funds, largely is coming from US. The next is Japan, and some amount of pension funds have come largely from Canada. I would assume these three countries will continue to have very high confidence in putting money in India. The last, of course, is the which is government of Singapore has been extremely active in India in taking ownership in majority of the companies in the financial sectors. Even the real estate sectors, commercial real estate sectors, they have been quite active. I would assume these four countries will continue to be a major investor in India. And lastly, from India point of view, where we are quite bullish on India, though the rates are currently as low. I think the next round of reforms that Modi would take, this is my personal gut feeling, that having seen Indian corporates rallying around the government of India in providing lots of money for the COVID funding, Indian corporates have shown the strength, work with the government during the COVID period. In my view, that will go a long way in creating a high impact for Indian corporates. The next round of reform it as post-COVID lockdown is over.
Thank you, Father. We have an anonymous attendee here who's asked a question for Prakash. He asked, in the infrastructure sector, opinions appear to be divided on public-private partnerships. In your view, will the government push ahead for new investments through this route? And will private sector have the appetite to participate?
Yeah, that's again a good question. See, I think the government would definitely go ahead with the public-private partnership route because, as I said briefly in my speech, I don't think the government by itself will have the wherewithal to invest $1.4 trillion in the next 5 years for the infrastructure space. It has to necessarily come from public-private partnerships. In what form and whether it will be a higher amount of public and lower amount of private is something that we need to see, or like the hybrid annuity, if will the government contribute some sort of a equity capital and let the promoters contribute a lower amount of capital. That's again something that we need to see. As far as the private sector's appetite is concerned, my view is, see, the private sector is essentially, they are risk takers in terms of EPC, in terms of building projects. They should not be hanging on to the projects because once they have actually built out the infrastructure project, then it needs to move to long-term investors like pension funds. And he needs to move to the next opportunity to bid and build, because that's what they are very good at. In India, what happened is most of the infrastructure developers willy-nilly have actually held on to the asset for no reason, because cheap debt was available. And as debt gets more and more difficult, now we see that there are so many private sector operators who actually are willing to let go of their assets, and these are actually moving to funds and to long-term investors. So I think it's a natural progression from risk-taking developers to actually build out the assets and let this move to long-term investors. And that is already happening. And once the developer lets go of his asset, he is actually having money back to invest further into the new projects where actually their strengths lie and where they have a higher return. So I think this will continue. Yeah.
Thank you. I might just, I like this question, and maybe both of you can have a go on this. And it's from Brahm from Tap Capital again. What will your message be to other asset owners in Australia with respect to asset allocation to India? What investment strategies will you recommend them to consider investing into India? Listed equities, private equity, REITs, private debt, venture capital, venture debt. What will be your reasons for some of these sectors as a preference over other sectors?
Yeah, well, I'll go first. I think the way we see is, I think India will continue to provide greater opportunity in the consumption led investment opportunities. That's a permanent theme, and so that could be one. It is a secular theme for India. We have seen sectors which are secular sectors does not get impacted by the political environment as well as the kind of volatility that we see in the global economy, and especially cyclical sectors. That's something that can be part of your core portfolio. At the same time, at this point of time, definitely there is a great opportunity to look for the financial sectors got beaten on very badly. It's one of the worst performing sectors at this point of time. People are just writing it off. 10 years of outperformance is the one which I think is make the sector suffer. Maybe it's just question of time, for maybe 6 months or 9 months. One will be able to find enough opportunity in these sectors during that this time to invest, because the valuations are attractive, and the sectors will remain as a proxy to the Indian economy at any point of time. Therefore, that sectors I think could potentially be one of the opportunities. Third, of course, though I get into the domain of Prakash, I think today I see a lot of the power sectors, good run companies, whether it is in power sectors, whether it is in the road sectors, could be available at reasonably good yield. Because naturally, the lockdown, your income levels are all below and will not be able to actually justify some of the price of these securities. So naturally, that's a segment I think one can look at it if somebody has got the longer term appetite. This on the bond side, I'm just saying. Otherwise, any bond that I touch, the yields are pretty low, and only the segment where there is a good spread that's available is on this segment which I just mentioned.
Yeah, just to add on what Bala had said, I think an investment strategy is a combination of listed and unlisted and space and securities, including equities and bonds, right? So that's typically any investor would look for. Since Bala has covered the listed space, I would like to talk about the unlisted space. See, as in India, you need to have one or two things that are very, very important. First of all, you need to have a credible partner when you are investing in India. That's first thing. The second thing is you need to have a long-term outlook, because India is an evolving economy and there are so many opportunities. At the same time, you need to give time for the sectors to mature and give you the returns. So that is the second thing. The third thing is, you need to choose the sectors where there's a governmental push is there. Obviously, when the renewable energy, when Government of India said that we will have 175 gigawatt of renewable energy generation by 2022, at that time we had hardly 30 gigawatts of renewable energy. But, that is a governmental push that has created a huge amount of opportunity in the renewable energy space. So you need to closely follow what sort of government policies are helping which sector. Fourthly, I think technology, maybe this is venture space. There are so many opportunities. India has more than, I think we have got more than 50 unicorns, and there are Sunicorns. There are about 100 Sunicorns are there, and this is a time when actually foreign capital is a little hard to come by. That is when they present a huge amount of opportunities, particularly for investors in Australia. I think infrastructure, which is long-term, having a credible partner, and then look at technology, and fourth, government policies which are giving a push. This is how you need to create your investment strategy, is what my advice.
Wonderful, thank you. We have so many questions here. I might take the last two, and then we'll call it we'll close to the meeting. The first one is from Natasha Jabaska. She asked, the speed and scale of recovery will be critical to the overall economy. How promising is the road ahead with demand, supply, and credit risk?
Yeah. One more take.
Sorry, say that again. Sorry, I couldn't get it fully.
The question is speed and scale of recovery will be critical to the overall economy. How promising is the road ahead with demand, supply, and credit risk?
Yeah.
So, shall I go first? I think, see, the speed of recovery in a country like India, I think where the demand is always there and there is a latent demand. In fact, today, if the lockdown is lifted, I am sure so many people want to travel. Okay, so I think the speed of recovery will be very quick. It's in many of the sectors. Not all sectors. Obviously, if you ask me whether the air travel will come back to the pre-COVID levels immediately, it might take a longer time. But in many other sectors, first thing is, I think there would be a quick recovery is what I think. The second thing is demand. India is actually a demand-driven country, and with supply constraints most of the time, I don't think there would be any depth of demand in the days to come. On credit risk, it is an interesting thing, interesting question, because there would be a little bit of deterioration of credit risk in the overall, but you know, the people with access to capital, the people who have good governance, are the people who are likely to come back very strongly.
Yeah, I just I think I fully agree with Prakash. I think once the lockdown is over, we could probably see things come back to normal. But of course, at the same time, it doesn't look like we'll probably see a V-shaped recovery, because if there's speed, then it has to be a V-shaped recovery. Then it may probably get into somewhat of flat growth. But we see actually the U-shaped recovery, because the government, unless they actually go and push very aggressively, taking a bet the way I think Fed has done, Indian government does not have that kind of room to do a fiscal stimulus. Therefore, they need to take baby step kind of things. Except that probably they will take one step, which I think giving a big push to the credit market confidence coming back. Once it comes, maybe it will take about 6 to 9 months for that growth actually gradually to come back. I think one of the sectors, the lead indicator which all of us keep looking at, of course, airline industry is one, has been giving very high growth in the last 4 or 5 years. Now it's gone for a toss. Of course, obviously, I think that could come back. The auto sector is generally the lead indicator for Indian economic growth. That is again something which we have addressing it. The last, of course, finally, if they're able to do it, I think the government is looking at the sectors like mining sectors is the one which I think India has got a huge potential, as well as can create a huge amount of employment for people who are middle income class people. If they're able to fix it finally, then we will probably see a faster growth coming in the next, say, 12 months period. So the speed could be a little slow, but of course, definitely the next 2 years of growth could be far better than what you've seen in the last 4 or 5 years.
Actually, Prakash, I really had a question for you before I go to the final one. I hope you don't mind. I think it must have been about 4 years ago. I hosted Arun Jaitley when he was the finance minister, and we had a round table with at least 30 Australian super funds and institutional investors. The big elephant in the room for Australian institutions and super funds was the retrospective tax. how can we, because Australian investors are very conservative in this area, how can we alleviate their concerns in regards to investing in India, understanding, you know, their concerns over the retrospective tax?
So I'll go. It's a very difficult question at this moment. But one thing I'll say is that you know, it is actually the way the word retrospective taxation came into being is not. It doesn't clearly give out what exactly had happened. So in that particular transaction, they knew fully well that there was a taxation, and they had structured it in such a way that this will not come to the tax network of the country. So the government had to actually do something to make it amply clear that this falls within the ambit of the Indian taxation. I don't think this is a very, very rare instance where there's something like that has happened. But I don't think when the government has actually come out and they have been rolling red carpet over a period of time, and they have been reassuring investors that there won't be such type of challenges that the investors will face. And I also don't think any of the super funds or the institutional investors actually had faced such a thing in India. That was a one-off transaction where it had actually received much more publicity than what actually was the background.
Thank you. Last question comes from Giles Gunasekara, and Giles asks, what's the outlook post-lockdown, especially for physically distancing and subsequent outbreaks?
So at this moment in time, it's a very difficult question to answer because I think already we have seen that there are the social distancing norms are being implemented. Everyone has come out with their own versions of implementing the social distancing. My view is that for the next 3 to 6 months, by which time I suppose a vaccine could actually be developed. My view is for 5 to 6 months to come, there would be challenges in terms of implementing all these new guidelines that of social distancing. But over a period of time, we have seen SARS and we have seen the Ebola outbreak. I think things will come back to normal once we have some sort of a cure or some sort of a vaccine for this. And I think there are so many efforts that are on in different countries. And India also has been testing, making clinical trials on some of the stuff. I think although commercial production might take slightly longer, but I have a strong feeling that we should be able to get to some sort of a treatment of vaccine in the next 6 to 7 months.
Bala?
I think in India, I think, of course, I'm just waiting for the Sunday night. The Ministry of Home Affairs is supposed to come with the third round of easing of lockdown. I think some of the plans they have is, I think the entire labor force in India today is sitting at home, not getting their daily income for the survival. The government has been supporting. So naturally, they have to make them actually go to work. I think they are planning to actually have some bit of mechanism by which they'll be allowed to undertake certain work, which are for the livings. I think the office spaces, I think all of us are running a huge amount of employee force. Again, started actually giving the policy that they need to adapt with the skeleton staff and some bit of work from home alternate days kind of thing. That's something that seems to be now be the way of life. And I think certain sectors, I think it's going to have a tough time. Like I think the airline industries, if they keep the social distance as one of the norm, naturally none of the airline industries will be able to run a profit. These are some of the things we'll have to just wait and see actually how innovative way of doing things. I think it will have to come from the government. But in India, especially, we are waiting for this circular. And lastly, I just wanted to also mention that during this lockdown period, so I was talking to some of these corporates in India who runs manufacturing unit. As long as the government has allowed them actually to continue their production, as long as they operate in a community kind of model, as long as the people who are working in the factory do not go out every day home and then come back through travel, and they've been asked to provide a shelter within the factory itself, and of course maintain some bit of distance. At the same time, they can continue to work. I think some of the factories like steel, aluminum, and pharmaceuticals, all these companies have been running smoothly. Of course, they will not have had an opportunity to export any of their items that they are producing, except moving within the country for essential purpose. Therefore, I would assume there will be some policy which will come from the government very soon in India.
I'm really cognizant that we're almost half an hour over time. I would like to take this opportunity to thank both Birla and Prakash for taking the time to be with us this morning and this afternoon in Australia. Both of your presentations were thought-provoking, were detailed, and there's a lot of information for us to take in. Really appreciate your time today. Thank you very much, gentlemen.
Thank you. Thanks, Dipen. Thank
We'll
you.
speak to you soon. Hopefully you'll come back post-COVID-19 and we can pick this up again.
Yeah, sure.
Thank you.
That would be nice.
Bye-bye. Have a wonderful day and have a wonderful weekend. Bye-bye.
Thank you. Bye.